Joining us now, Jeremy Siegel, Professor Emeritus of Finance at the Wharton School. Professor Siegel, great to see you. Good morning.
Good morning, Melissa.
Is there anything about the composition of this rally that concerns you? The fact that it's so AI reliant, the fact that AI spend at this point is heavily financed, anything?
Well, let me tell you what I'm looking at. And, the most important variable for the economy is really not inflation. It's not employment. It's wages after inflation. That's real purchasing power. And really the most disappointing data I saw on Friday was what wages were up. And they were only up 3.2%. Now on Wednesday, we're going to get the CPI. That's expected to be up 3.4. So what does that mean? Workers are losing to inflation. Now, what's the biggest source of, workers gaining to inflation? And that is productivity growth. And frankly, productivity growth in the last 3 quarters has been very disappointing. We need to ramp that up. And there are some positive signs for this quarter, but the last 3 quarters have been below the 15-year average. And that's one reason why I think a lot of the public is not happy with the economic performance, is they're not gaining on inflation. So what we have to see is that AI working to actually increase the real wages of the average person. I mean, I'm very interested. My good friend Kevin, I hear you're going to be interviewing him in a few minutes. I certainly want his take on that. But that's what we really see. We need to see in this economy, I think, to really turn it around and get people feeling good about the economic situation.
Do you think that we're in the sort of a handoff stage where we're spending on AI? AI is causing inflation in the economy, and workers are not yet benefiting from that. So we're in this transition period.
Well, a longer look. Now, GPT was introduced in November of 2022. The average productivity growth since then, so, we get almost 4 years, has actually been 2.5%. And that's not bad. And that's better than the last 15 years. Now, it's not good as the golden years that we had 1950s and 60s when we had, over 3%. But it is better. But we've fallen off of that in the last 3 quarters. Now, maybe it's the oil situation, maybe it's other situations, but we need to get back on track. Now, some of the good, one of the pieces of data that actually was promising is that even though we didn't get a lot of increase in employment for the month of July, GDP estimates are holding. In fact, the Atlanta Fed thinks it's going to be over 5%. I think that's too optimistic for the 3rd quarter. Goldman Sachs thinks it's going to be 2.6%. But if it's going to be 3 or 3.5, without a lot of need for more workers and hours, that's going to boost productivity. That's going to boost real wages. And that's going to boost the entire economy. So I think we've had 3 quarters of us falling back. I'm looking for this next quarter to bring us back up. But I think that is really why a lot of people are just really not happy with the overall economic performance over the last 12 months.
To get at that affordability issue for workers, should the Fed hike rates? Should we have done that before the last meeting?
Oh boy, that's a difficult question. I do see a little bit of slowdown in money growth, which is something that concerns me in terms of inflation. I mean, the situation in Iran is the biggest one, and what's going on in oil. I mean, if oil stays where it is or goes down, honestly, it's going to be pretty hard, I think, for Warsh to increase, especially since I hear he has very frequent conversations with President Trump. And we're going to get some better news on the gasoline front and some of those other fronts coming forward. If things fall apart, if hostilities begin and we go back up, then it's a whole new situation. And of course, we have only 3 months until the midterm. So, this is getting more and more compressed. what actually the public can see and what we can actually do.
It sounds like, if I just were listening to you speak, Professor Siegel, and I didn't know what the S&P 500 was doing right now, which is basically sitting close to record highs,
yeah.
I wouldn't think that the picture's matched up. So where do you stand on the markets, given all what you said and the concerns you have about the economy?
Well, there's a number of things. First of all, the market is not Main Street. The market could do great, and the worker may not be doing so great. Profit margins are incredible, especially for the technology group. They're going up. The hyperscale spending is doing well. It's 40% of the S&P. So that can continue to do well. And as I said, I'm beginning to see signs of this third quarter that might be spreading to other areas. My big hope is that the AI gains that we hear so much about and, that we're using can filter down to the average company that can implement it and say, look, I can get better margins too. That hope is, I think, what is keeping the stock market up. I'm not pessimistic about that. I'm trying to kind of get a kind of reconciliation between the fact that we're, looking at wages not keeping up with inflation. We're getting that in 2 days. And yet the stock market is doing great and AI is there. And how are we going to reconcile all these things together? And part of this is just a timing issue. And as I said, I see seeds of good hope and, that the third quarter might bring these two factors back into a reconciliation.